Hello and welcome to another episode of Full Court Finance here at Zacks. Today we're diving into if investors should start buying the FAANG stocks again as big tech continues to drive the coronavirus market rally. So that's Facebook, Apple, Amazon, Netflix, and Google. And we're also going to throw in Microsoft into the mix here as well. But before we get into everything, I want to say, remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts. And make sure to check out our new zacks.com/promo page for a look into some of our services, portfolios, and more. All right, so we're recording this on a Friday morning. I normally record these on Monday mornings, but it's a long holiday weekend, so we're doing this on a Friday morning. So right now on Friday morning, we're going to do a little market overview before we dive into these big tech players. So last night, China imposed national security laws on Hong Kong, which could increase the negative rhetoric against China. This took a hit on the Asian markets, and it took a little bit of a hit on our markets here in the States on Friday morning. Plus, China also said it wouldn't set its GDP target for 2020, which is an unusual move because it's the first time that a formal target has been omitted since the practice began in the mid-90s. And this also suggests that Beijing's leaders are not necessarily eager to put out large-scale stimulus after China's really sharp contraction, its sharpest contraction in the last 40 years amid the coronavirus. So obviously, with the world's second largest economy taking a big hit, this has people maybe a little more nervous about what's going to happen in the second half of the year. And then meanwhile, in the US, nearly 40 million people have now filed for unemployment since the pandemic began. But nonetheless, the S&P 500 has surged roughly 32% from the market's March 23 lows as Wall Street continues to look ahead to the coronavirus recovery. And stocks surged to start the week on the back of some positive coronavirus vaccine news. And this comes as economies around the world and in the US slowly start to reopen from their coronavirus-induced lockdowns. And then on top of that, it seems like investors in Wall Street are going to remain in the larger don't fight the Fed mode as the central bank does all it can to support the markets, and the US government provides as much economic stimulus as possible. And this is likely to go on for at least until the November elections, where no one's going to want to seem on either side of the aisle that they're unwilling to help out the struggling American economy, which was forced to shut down due to no fault of their own, basically government decree. So there's going to be massive economic stimulus for at least until the fall. So with that said, the full impact of the coronavirus shutdown certainly won't be felt until at least the second quarter earnings. And economic data seems to be, it's going to be getting worse before it gets better. So with that said, the S&P 500 is projected to see its earnings tumble about 43% in Q2 and over 23% in 2020, which is far worse than what we've seen so far in Q1, which actually doesn't include that much of a coronavirus impact, since most of these results are from the quarter that ended on March 31st. So with that said, the market is looking forward and will continue to look forward, in technology stocks that help drive the historic bull market that the coronavirus abruptly brought to an end. These same stocks are the ones that are driving this new rally over the last 2 months, and the industry in general has seemingly picked up kind of right where it left off. So in fact, you had Amazon and Facebook both hitting new highs this week, and Netflix broke into a new range earlier in the month. So now we're going to start to take a look at some of the broader price movement of these stocks compared to the broader market. And then we'll go through these stocks on a case-by-case basis through these FAANG stocks, plus Microsoft, to see what investors should maybe do with these big tech giants going forward as we head into the summer. So right now, so far in 2020, Netflix has been the top performer of these FAANG stocks, plus Microsoft. You have Netflix up about 35%, and then Amazon is the second biggest winner, up about 33%. And then you have Microsoft, Facebook, both up about 15 or so percent. Apple and Google up a little bit less than that at under 10%. And then overall, the S&P 500 is still down around 8% on the year. So Netflix and Amazon have been the big standouts so far in general in 2020, as their stay-at-home style businesses were really attractive to investors early on. So they didn't suffer as much as part of the big market sell-off. So with this in mind, since the market starts to rebound on March 23rd, so since those March 23 lows, Facebook has been the top performer, up about 57%, and then Apple, followed by Microsoft, Google, and then Amazon and Netflix have lagged the broader market over this 2-month stretch, which kind of makes sense since they had much less room to climb, given that they didn't fall as much as the broader market during this time. And then if you look over the last 2 years, just to give people a perspective of these big tech players over a broader period of time, Microsoft has been the winner. They're up about 90% over the last 2 years, compared to second place Apple at about 70%. And then Amazon is in third place, up about 55%. And Netflix is up about 30%, Google's up about 30%, and Facebook is up about 26%. So Facebook has been the lagger of these 6 big tech companies over the last 2 years. But this helps put into perspective why Facebook has been able to have this big rally over the last couple months. So in general, they've all outperformed the market, but it's been Microsoft and Apple that have been the big winners over the longer period of time, with Microsoft or with Amazon in third place. So with this all in mind, we're going to start with the FAANG stocks by, of course, looking at Facebook first. So Facebook hit new highs on Wednesday after it announced its new Facebook Shops offering that will enable users and businesses to essentially create streamlined, sort of pared down versions of their e-commerce sites directly on Facebook and some of its other services. This is part of Facebook's larger e-commerce push as retailers around the world struggle, and it really couldn't have come at a better time. And this is alongside its marketplace and people being able to shop on Instagram, and it's going to help it better compete against Amazon, eBay, Etsy, and other e-commerce players in what is a booming market. On top of that, in April, Amazon said it would pay roughly 5.7, so about $6 billion for about a 10% stake in Indian telecom powerhouse Jio Platforms. And this is a huge bet on the Indian market, where Facebook already has over 400 million WhatsApp users. And this could be a big thing down the road, as the Indian economy is massive, over about 1.3 billion people up there, with China in terms of the biggest global population. So that could pay some dividends down the road for Facebook. And then overall, their Q1 results were pretty strong. Daily active users were up about 11% to 1.73 billion. This growth helped Facebook's Q1 revenue climb about 18%. And executives also calmed some Wall Street nerves about its advertising sales during the coronavirus, saying that things had smoothed out after a rough drop in advertising sales in mid-March. And as we mentioned, the stock's up big since mid-March, up about 60% since the middle of March, and is still trading at a discount compared to its 1-year highs. And alongside that, Facebook's balance sheet is also strong. It has a massive pile of cash it's sitting on that can help it weather any further coronavirus storms and continue its expansion into e-commerce, augmented reality, and more. So overall, Facebook is currently a Zacks ranked number 3 hold that longer term investors might really want to consider looking at, because it's nearly 2.6 billion monthly users, makes it an advertising titan for years, if maybe not decades to come, in an age where people pay not to see ads everywhere possible. So this is from Netflix to Spotify to on down the line. So eventually, Facebook might even become more powerful of an ad player as more and more people try to not see ads anywhere they go. And now we're going to move on to Apple. And Apple, doesn't really need much of an introduction. None of these stocks need much of an introduction. Apple is clearly another safe tech bet. It has been for the better part of a decade, and it's a safe bet despite some pandemic-related iPhone setbacks. Apple beat our Q2 fiscal 2020 estimates at the end of April, driven by its non-iPhone units once again. So this is its services division, which includes its App Store, its new streaming TV offering, and more. That revenue jumped about 17% to a new all-time record. Meanwhile, it's a wearables division, which includes those AirPods you see everybody wearing, those cordless wireless headphones. That division was up 23% to a new quarterly record, which is obviously a great sign for Apple that they're able to expand their non-iPhone business, which is what they've been trying to do for the last several years. And along the same lines as Facebook, and perhaps just as importantly amid these unprecedented times, Apple closed the period with $193 billion in cash in marketable securities, alongside total debt of about $110 billion, which left it with net cash of $83 billion. So massive cash pile for Apple. The company also lifted its quarterly dividend by 6%. Its yield sits at about 1.03%, so call it 1% at the moment. Easily tops the 10-year U.S. Treasuries payout. And then on top of all this, Apple's board authorized a $50 billion increase to its stock buyback program. And this is great news for investors. And it also shows Apple's real strength at a time when fellow giants and the likes of AT&T and other big companies have suspended their share repurchase programs amid all of this coronavirus uncertainty. And as we mentioned, Apple stock is up about 40% since March 23, and it currently sits just off its 52-week highs. Apple is also currently a Zacks ranked number 2 buy at the moment that sports B grades for both value and growth in our style score system. And even near its highs, longer term investors really might look back in a year or so from now and think, why didn't I buy more of Apple stock when it was at its current price? So longer term investors might want to consider Apple, even though obviously all these stocks could pull back in the near term if we have any more negative coronavirus news. But for all the reasons we just mentioned, Apple seems like a really safe longer term play given its massive pile of cash, its dividend, and its ability to expand beyond the iPhone. And now the next company on this FAANG list is going to be Amazon. And Amazon really does seem tailor-made to outperform during these uncertain times, as its stock price movement has shown in 2020. And its pitch to investors for years really has been that it operates a business built for the future. And this has become crystal clear during the coronavirus pandemic. For instance, Amazon's core e-commerce business, which includes online store sales and its third-party seller services, accounted for about 72% of total fourth quarter revenue in 2019, and its Prime heavy subscription revenue accounted for about 6%, and its AWS cloud computing business was about 12%. So it's an e-commerce player and it's a cloud computing player, which are both businesses that are going nowhere anytime soon. And on top of that, its fastest growing segment in the fourth quarter, and obviously it most recently reported its Q4 results, but this is kind of a broader picture that's not influenced by the coronavirus in any way, was its digital advertising heavy other unit that climbed about 41% in the Q4. And now Amazon is the third largest digital advertiser behind Google and Facebook. And it also competes against Netflix and Disney and Apple in the streaming TV market. So it's really a big bet on the future of businesses, or the future of e-commerce, entertainment, and computing. Amazon's Q1 earnings did miss our estimates, and they were missed relatively by a big amount, 21% they missed. And overall, its profit fell by about 30% from the year earlier to about $2.5 billion. This came as Amazon spends way more heavily to meet the big increase in demand. So with that said, the surge in online buying at one point forced Amazon to temporarily stop taking inventory for products that were deemed non-essential. It hired 175,000 more staffers for its warehouses and delivery network. And it ended the quarter with what it said was 840,000 employees. So a lot more spending, but its sales jumped 26% during the quarter to about 76 billion, which was by far its highest on record for what is normally its slowest period of the year after that busy holiday shopping season. With that said, Amazon's earnings revisions have trended in the wrong direction for the current year, fiscal 2020, but they've been mixed beyond that to help it hold a Zacks rank number 3 hold at the moment. And if we look ahead, its top line is expected to climb another 27% in Q2 and about 23.5% for the full year. So continue impressive top line growth, but then on the bottom line, we're expecting another significant pullback in terms of adjusted earnings. We're calling for a 70% decline year over year, but it's still expected to pull in about $1.56 per share. And then about a 15% decline on the bottom line for the full year, but then it's supposed to bounce back in a big way next year once hopefully all of this coronavirus chaos is in the rearview mirror. And with that said, as we mentioned, Amazon stock hit new highs earlier in the week, and it currently rests right near those highs. And its valuation picture, despite that, is pretty solid. It's trading at 3.3 times forward 12-month sales estimates, which is right in line with the S&P 500's average. So for a company that's a big growth company, and it will be for years to come, and a company that certainly outperformed the market for years, trading at 3.3 times forward sales is pretty solid. And like with Apple, longer-term investors will likely look back in a year or so from now and think Amazon's current price looks something close to a steal. So another solid stock to consider amid all of this. And then we're going to move on to Netflix. Netflix is currently the world's largest streaming TV firm. It closed the quarter Q1 with 183 million subscribers worldwide, and it expects to hit over 190 million by the end of the second quarter. As some of you might remember, which now seems like forever ago, Netflix blew away its own Q1 user forecast by adding about 16 million new customers, which more than doubled what it had forecast, which came clearly before the coronavirus turned into a global pandemic. With that said, the company said that its massive growth was unlikely to continue going forward. And the company said in a statement at the time that, like other home entertainment services, we're seeing temporarily higher viewing and increased membership growth. But they noted that we expect viewing to decline and membership growth to decelerate as home confinement ends, which we hope is soon. So despite that positive sentiment on their end, even though things are starting to return to something more close to normal than they have been recently, it's unclear exactly how quickly we will get back to anything close to normal life that soon. So even if things do start to reopen, it's unlikely that concert venues and sports arenas and movie theaters and any of these big venues that could be called quote unquote super spreader events are going to really open anytime soon. So, and even if they do, it's doubtful that people will rush back into crowded movie theaters or sports arenas or anything like that. So it does seem that Netflix will be able to continue to ride this wave of people spending more time in at-home entertainment, at least until there are more signs that the coronavirus is maybe petering out, or there's a sign of a vaccine actually coming sometime soon. So with that said, obviously Netflix does face competition from newcomers like Disney and Apple TV and the beefed up HBO Max, which rolled out this month. And with that said, though, there are millions of people set to cut the cord over the next several years. And unlike, say, Apple Music versus Spotify, the streaming TV firms in general offer vastly different content libraries. So therefore, someone who's signing up for Disney Plus won't necessarily dump Netflix and vice versa. So it's not that if you have Netflix, you're not going to have any of these other streaming services. You might have multiple, since they're all offering various different things. So if we look ahead, Netflix is expected to see its revenues grow by about 23.3% for Q2 and about 23% for the full year. And its earnings are expected to grow in a really big way. So it's expected to see a 205% jump in adjusted earnings in the second quarter and a 55% jump for the full year. So some really positive buy-live movement, especially considering the broader earnings trend that we're looking at for the S&P 500 amid all of this craziness. So with that said, Netflix has also seen its earnings revisions trend higher. This helps it hold a Zacks rank number 2 buy at the moment. And with this in mind, the stock does in general tend to trade, especially in the near term after its quarterly results, based on if it beats its subscriber goals. So obviously there was a really massive beat in the first quarter. So anything that's deemed as underwhelming in Q2 could send the stock not tumbling, but back down in the wrong direction, even though it's ideally built for the current at-home situation. So anyone who thinks the coronavirus is going to continue to linger, Netflix could certainly be a stock to hold on to. Some might be a little worried about its growing debt load that it's taken on to finance its content, but it is trading at a discount to Microsoft in terms of forward sales, and it's really one of the only pure play investments in what is sure to be the future of entertainment, and it does have a major head start on many of its rivals. So Netflix obviously does still present some solid opportunities for investors out there now and in the future. And then we're going to look at Google, which actually is Alphabet, but for the FAANG, it's considered the G in the FAANG there. So Alphabet is currently a Zacks rank number 3 hold that rests around 8% off its highs. It jumped after posting solid Q1 results, but it did fall short on the bottom line, and it faces a rough near-term outlook in terms of global ad sales. Same thing Facebook is dealing with. So our Q2 estimates are calling for its sales to actually dip about 4% and its earnings to slip about 40% year over year, its adjusted earnings. So some certainly near-term headwinds for Google as the overall advertising business is taking a hit amid a drop in spending amid all of this uncertainty. But still, Google's search engines are pretty ubiquitous, and it's grabbing around 40% of total US digital ad spending, blows away second place Facebook and third place Amazon. And going forward, it's going to continue to attract advertisers for all the reasons we just talked about with Facebook, that Netflix and all these other non-ad supported platforms are proliferating pretty quickly. And then alongside its web browsers, Alphabet sells hardware such as home speakers and more Pixel smartphones. It also boasts a cloud computing business, an app store, and it has some bets on the future, including self-driving cars and more. With that said, Google could maybe face more pressure from the US government going forward. Obviously, a lot of these big tech companies have been in the news for the last several years for possible government pressure or government intervention. This Facebook, Amazon, all of these companies have been under some scrutiny, but certainly Google does seem to have a bit more of an outsized influence over the flow of information, and some of its ad practices have come under a little more fire recently. So maybe Google is one out of all of these to be a little more cautious about in terms of the possible government intervention, and obviously some near-term headwinds to its global advertising business. And now we're going to close out with a look at Microsoft. This is not a part of the FAANG group, but as we mentioned, it has outpaced all of these other FAANG stocks over the last 2 years. So we're going to consider this as one of the FAANG plus Microsoft stocks, which are really the big 6 tech players. So Microsoft topped our quarterly earnings and revenue estimates at the end of April, with its sales up 15%. Once again, its cloud computing business was the star of the show. Its intelligent cloud sales were up 27% for the second quarter in a row, pulling in about $12.3 billion. which was the most of all three of its units. Alongside Intelligent Cloud, its office-heavy productivity and business processes division jumped 15%, with personal computing up 3%. So all of its units were up in positive revenue, but Intelligent Cloud once again stole the show, up nearly 30% for the second quarter in a row. Microsoft is an industry leader in the cloud computing space. This is alongside Amazon. And alongside that, its Office suite of products remains vital to businesses, governments, schools, consumers, you name it. And more recently, especially during the stay-at-home environment, its Teams business has stood out. It shows that it's really ready to compete against smaller rivals such as Slack and Zoom Video for the long haul. So like Amazon and Netflix, Microsoft's business does seem really kind of tailor-made for the broader stay-at-home environment that we're in at the moment. On top of that, Netflix held over $135 billion in cash and equivalents at the end of last quarter. Its dividend yield rests at about 1.1% right now, and it might continue to buy back stocks, as we mentioned with Apple, where all these other companies are backing off those big share repurchase programs. So if we look ahead, Microsoft's current full year revenue is projected to jump about 12.5%, and then another 10% next year, and its earnings are expected to grow 20% and 9.5% respectively over this same period. And it's currently a Zacks ranked number 2 buy right now, and its stock is up about 35% since the market's lows. And it's currently, like a lot of these stocks, trying to break through some new highs. And for all the same reasons we talked about with Apple, they've been the two biggest outperformers over the last 2 years. They have outsized impact over the market in general for how big they are, trillion-dollar companies. Both pay a dividend, both sit in lots of cash, both run businesses that aren't going anywhere anytime soon. So if you're looking for a safe, longer-term bet, Microsoft is another company to certainly look at, both for the coronavirus economic situation we're in and longer term once we are out of that. So that does it for another episode of Full Court Finance. I hope everyone has a great holiday weekend. So until next time, I'm your host, Ben Rains. And remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.